Welcome back to the America Zone of the Impact Summit of the Singapore FinTech Festival. I'm Glenn Van Zutphen, and you are on the Global Common channel with us today. Well, what started as an innovative concept for micro-investing spare change has grown into a mission to look after the financial best interests of the up-and-coming. With the pandemic making worse what was already a financial health crisis for many Americans, we asked Acorns Chief Executive Officer Noah Kerner about helping people break the cycle of living paycheck to paycheck and to plant financial seeds to grow their own oak tree. Well, here to moderate this fireside chat is Matt Harris, partner at Bain Capital. Now, just after this chat session will be another session from the Block Show segment, moderated by Gabriel Yang, head of strategy at Block Show. He'll be talking to Balaji Srinavan, co-founder and board member at the Coin Center, on the impact of decentralization. But before that, let's head over to join Matt and Noah as they talk about growing nest eggs from Acorns.
Hello, thank you for having us. This is Matt Harris, partner at Bain Capital, where I run the FinTech practice. Joined here today by my good friend Noah Kerner, CEO of Acorns. For full disclosure, we are an investor in Acorns, but I'm happy to say Noah was a good friend before that happened, and remains a good friend despite all the inevitable twists and turns that come from venture capital investing. But Noah, thank you for being here. Why don't we start with a little introduction on your part. Tell us where you came from and how you got to be CEO of Acorns.
Thanks, Matt, and it's good to be here and agree through all the twists and turns. We've still remained good friends, so that's cool. My background is really a windy road. I started my first company when I was 21, right out of college, and just kind of pursued a path that connected to the passions I had at different moments in life. So early on, it was hip hop culture, then just creativity, music. I was involved early on in WeWork, and got involved early on in Acorns, just out of a passion for trying to help level the playing field, and that comes mostly from early life experiences growing up in New York City's East Village, public school kid by day, tennis player by night, sort of like playing with the wealthiest kids in Manhattan at night, going to school with the least wealthy kids in Manhattan in the day, and sort of had that dichotomous experience where I saw how different people lived, and that was a through line throughout my life. And I at one point wrote down what I thought my professional purpose should be, and level the playing field just wrote itself. So here we are.
Here we are. Tell us then about Acorns and how Acorns reflects that value of leveling the playing field.
So Acorns, today Acorns is just in America, and we're squarely focused on everyday Americans, which in this country is people who make 50 to 75,000 household income. Geographically speaking, our customers are everywhere across the country. Typically with tech companies, you'll see sort of focus in coastal areas or major cities. 60% of our customers are first-time investors, which is something we're really proud of, is bringing people into the system of capitalism, and giving people the opportunity and the access to the tools of wealth making that they haven't had before. So that's the customer base. And then our whole reason for being is to help everyday Americans save and invest every day. And that's really the foundation and core of Acorns. We think starting the relationship with saving and investing as early as birth, which you can do now on Acorns, is the right way to start. And that's the through line across someone's life. So all the way from birth to through retirement till the end, is like saving and investing should be the focal point. And in our view, the other products that we launch should help you maximize your saving and investing. And that's how we think about it.
Now, as we think about poverty and even income inequality in the United States and globally, a lot of people like to talk about universal basic income as an example of a poverty fighting measure, and a variety of other assistance programs that attempt to get resources to people who have less in the way of resources. Acorns takes a different approach in that, while most people in this demographic would say they don't save money because they don't have extra money, somehow Acorns enables people to save money, even though historically they've been unable to. So what's the magic trick there that takes non-savers and turns them into savers and then ultimately into investors? How do you do that?
Yeah. So in most of the other categories of finance, spending, payments, borrowing, trading, which is not something we do, there's an immediacy. There's a sort of immediacy of need, like I want to do this now. Whereas Acorn saving and investing for the long term doesn't have that sense of immediacy. So I think we needed to start with a hook that brought saving and investing more to the here and now, and that's where spare change comes from, like rounding up every purchase you make to the nearest dollar when you're going about your life. It just brings it adds resonance and relevancy to it. And I think that, that was really important, creating a sense of urgency and a sense that you need to start doing something that matters later now. So I think that's really probably the key to at least the beginning of it.
Yeah, there was this behavioral finance angle, to find a painless way for people to save money without even knowing it, and this idea of rounding up or spare change that Acorns really, as you say, was sort of the first plank in the platform and remains really, really important to our customers today. Speaking of customers, can you give just a bit of a sketch of the level of impact now? What's the size of the customer base? How do you think about its growth over time?
Yeah, so we've opened up over 8 million accounts in the US, and we've helped people save over $7 billion in small amounts of money. $7 billion doesn't sound, in the world of finance, $7 billion under management, it doesn't sound like a big number. But when you're talking about tiny increments, spare change, it really is a lot of money. When you're talking about mostly people who don't even have $1,000 in emergency savings, it's a really meaningful amount of money. So, that's our like, again, our focus is how do we get these customers saving and investing as much as possible so they have a better life later. We just actually did a study to find out the relationship Acorns has to confidence, hope, and then asking, do we really deliver on our mission? And we found out that 65% of our customers say Acorns gives them a sense of hope for the future. I'm really proud of that. 70% say that we deliver exactly on our mission, which is to look after the financial best interests of the up and coming. So, being able to deliver that kind of impact and not just the physical functional piece of a product, but the emotional side, because it is a very emotional phenomenon and thing in people's lives. There's a lot of shame, there's a lot of pain, there's a lot of embarrassment. People don't like to talk about money, right? So, and especially with so many people saddled with debt, hopelessness is a big problem. So the fact that we can bring people hope is important because you need it to take action.
Yeah. You talked about up and coming, but in fact, some of the more recent product energy has been focused on truly up and coming. So our recent product launch of Acorns Early focused on people well below the age of 18. Can you talk about the relevance of saving and investing for a 6-year-old, a 11-year-old? What's the thinking behind pursuing that product direction?
Yeah, that's simple. That's just about the power of compounding. So if you start with $5 a day at 18, by 65 or average age of retirement, you'll have $1.5 million. If you start at birth, you'll have $4.5 million. So I remember when I learned about the power of compounding and the magic of it. It really is a life-changing moment if you digest that and really apply that to the way you operate. So to understand that money grows on top of itself if you keep it invested is I don't think that there's any better lesson to teach people than that. And you can't save your way to wealth. I don't think you can.
So there's an important distinction there. Can't save your way to wealth. Implicitly, you're making the point that you can invest your way to wealth. And for those who don't know, what Acorns does is allow people to allocate their money to ETFs along a risk spectrum, but surely many of which are exposed to equities. And I wanted to press you on this a little bit. That's been a good choice for the last 10 years. Equities, there's been some chop, but it's been a really good ride, and Acorns customers have benefited. But, we don't know what the next 10 years are going to bring. The market seems awful high. Like, how do you think about risk as it relates to that distinction between saving for kind of a fixed rate of return and investing for an uncertain outcome?
We send this message to our customers that every downturn in history has ended in an upturn. So we went through obviously a really difficult period this year. I think March 18th was the worst day. I think the Dow now in the United States is up above 30,000. It was at 18,500 that day, and it had gone down 40%. And as usual, the world was coming to an end again. And if you read the news, you were like hiding out in your bunker. I had a relative who called me. I was like running to the bank to take all their cash out of the bank. And I mean, it was like that level of panic. I remember sitting in my place with my girlfriend at that day, and I called up my guys, and I just invested. I was panicked too. I mean, it was actually, that was a scary moment. But I remember in my head, every downturn ends in an upturn. Every downturn ends in an upturn. And if the world is really coming to an end, it doesn't matter anyway. So I just put in a whole bunch of money that day. And she was looking at me like I was nuts, right? Like and even though having lived through some of these things and all the lessons we try to teach people, like things are eventually going to come back, but it doesn't feel like it in that moment. So I just say, like, invest early, invest regularly, and turn away when things are tough. Just have faith that history is usually a predictor of the future. Not always, but it usually is. And if history is usually a predictor, then things are going to end up in a better place than they are when it's really bad. And so just stick with it.
And what did you observe this year in terms of people's behavior at the end of Q1 and into Q2, and the market looked at its worst? Did people panic and trade out of equities? How did they react to the market when it was on its way down?
Yeah, we were certainly really nervous that people were going to panic, especially our customers who were relatively newly initiated. And we've gotten this question over the years, like, what's going to happen when there's a really bad downturn? Starting in at the end of 2015, we said financial literacy is going to be a core component of Acorns, and we're going to do it the right way. We're going to do it with real journalism. We're going to bring top quality content, and we're going to focus on educating our customers because it's the right thing to do, but also for moments like that. So we had really been like driving that message home for a long time about long-term thinking, every downturn ending in an upturn. And when the pandemic hit here and the market crashed, we started a daily newsletter. We'd never done that before. We started a daily newsletter that was like just what's happening in money, no drama, just facts, what's happening in money today. And we did it every day for a couple months. And what we saw this year was our best retention year on record. So I'm really, it's not even proud. I mean, I'm really proud of our customers for not making the wrong choice. And my parents twice pulled all their money out of the market when they were a really bad market. As when I talk to my dad now, I don't know how much he lost, but probably 150% of his potential earnings. So,
just pressing on this point, there's panicking because the market went down and everybody's Acorns balance, went down 10 to 30%. And, it seems like our Acorns financial literacy program helped with that. But there's also just necessity. As the pandemic has worn on, as unemployment has remained stubbornly high, throughout the year, going into Q3, Q4, have you seen withdrawals that showed a pattern, not so much of panicking about the market, which of course has bounced back, but just people needing access to this nest egg that Acorns has helped them build?
Yeah, I mean, we haven't seen some really out of pattern behavior. We studied our customers. Well, we studied our customers a lot. We studied them during this thing, and we found out that 40% of them declared that they needed to pull their money out of the market. It was encouraging to see that 20% of them said they pulled their money out of Acorns. at a particular moment, even though 40% pulled it out of the market. So that was a good signal to us. But I mean, like if you need access to your money and you're in a pinch, you need access to your money, period, end of story. So we also make it really easy to withdraw your money, even though, you would want to create some friction there because you think but actually it's better to focus on transparency and trust. So we make it really easy, and people have pulled their money out, but not in like a really out of pattern way yet. So I think it'll depend on how the government stimulus programs, how that plays out, whether the government here can get it together and actually agree on something and put a new stimulus plan in motion, which I think they have to. So
stimulus is only so much we can do. The government has to play a role. But what can Acorns do relative to the income side of the picture? Do you have anything in mind where you can not just help people with the income they have, but actually help them generate more income?
Yeah. Back to the central purpose of Acorns, which is to help people save and invest. Obviously, the number one culprit in terms of saving and investing is not earning enough. It's like when any study will say the reason people don't save enough is because they don't earn enough. So we got in a few years back into a product line just helping our customers earn extra money, and also felt like that was an odd thing that's missing from financial services generally. Like I asked the question, why don't banks help people with earning income, which is, I mean, really, like it doesn't make sense. Like there's this whole other industry called jobs. And why aren't they together? That just seems like there's an opportunity there. So anyway, we started helping you earn when you spend, earn on the side, earn from remote job opportunities, earn from full-time job opportunities. We've sent a couple 100,000 people to new job opportunities over the last couple months, and that's a big focus for us and a priority for us as we go forward, because again, saving and investing is the foundation, and we want to help people save and invest as much as possible. So some extra earnings. And by the way, like, we have opportunities you can earn from taking surveys, from quizzes, from being an Uber driver, from renting out your place, from being a Skillshare worker. Like, there's all kinds of ways to earn extra money if you really just, get to it.
Yeah. So you mentioned the failings of traditional banks. These limitations or failings have been noticed by a lot of different entrepreneurs globally here in the last 5-6 years. And we've seen really a new category created. People call them challenger banks or neobanks. And we could name dozens that have global scale, and then each country has another couple dozen. Acorns often gets lumped into this category of neobank or challenger bank. Do you agree with that? You think Acorns is one of that set of companies? In what ways is it different from the rest of the challenger banks?
I think people create designations and boxes to make it easy for other people to understand what they're talking about. I don't consider us, well, someone once said to me, run your own race, which I think is some of the best advice you can give. So I don't think of us as like a neobank that's part of a moment of time fad that's happening now. Like I view saving and investing as something that people need to do from now till infinity. And Acorns is a saving and investing app. Like that is the foundation of our product. The fact that we have a spending instrument is only there to help you spend less so you save and invest more. And that's how we think about it. Like we have a long way to go with that product, but I don't like being lumped into some kind of momentary trend. I want Acorns to be here hundreds of years from now, and saving and investing is a need, not a want.
The advent of these neobanks or challenger banks really is a reaction to a perceived set of limitations of the incumbents. And depending how you count, there's 15 to 25 million accounts at these banks, either primary accounts or secondary accounts that have been set up and growing quickly. So approaching 20% of all U.S. households have made the decision they're going to open up a second bank account or replace their primary bank account with one of these tech-enabled competitors, whether it be Cash App from Square or Chime or Acorn spend, et cetera. And the numbers are even more dramatically true in the UK. And Singapore just announced 4 new banking licenses for tech-enabled companies. So it's truly a global phenomenon. If you had to forecast based on the cockpit that you're in, do you think banks, proper traditional banks, will actually lose market share in the double digits, that what we think of as the core banking activities, the place you store your money, your checking account using traditional nomenclature, will actually shift in meaningful ways from regulated banks to these tech-enabled companies? What does your crystal ball say about that?
Absolutely. Yeah. I mean, there's no question. I'm not a believer that direct deposit is like the end be all end all glue lifetime value driver, which is historically it has been. I think that's going to change as technology makes it easier and easier to switch, just like technology has made it easy to open up all these different technology products through Plaid. Like if it's really hard to move your direct deposit around in 3 years, something's really odd. So I think, I think in the end, and that's why when we say financial wellness system, like I think the winning model is a system of products that works together to help you toward some end benefit, and that ultimately locks you in rather than a drop-down menu of options. And I still see in fintech, I mean, and obviously people are gaining some real traction and momentum here, but it still really feels like the drop-down menu of options that once was, which is get this account, get this loan, start trading these stocks, use this, use that, like it's kind of just a digitized version of what has been. And I don't that doesn't feel revolutionary to me.
One of those options, as you mentioned on that drop-down menu, is loans. And as you think about a complete financial solution, again, at least in the historical context, lending was a big part of it. And if you look at the profit pools available to retail banks, lending, mortgages, personal loans, auto loans, credit cards, drives a lot of the profits. And as yet, to my knowledge, Acorns doesn't have a lending offering, despite having touched most of the pieces around consumers' financial life. Can you talk about your point of view on lending and why it's either not on your product roadmap or it's come quite late in your product planning?
Yeah, it is. There is an aspect of it that's on our product roadmap, which is to help you pay down your debt. So that's a core aspect of our product offering. I imagine at some point Acorns will help people get access to extra liquidity and things like this, but it has to be done in a way where we're not burdening the customer and putting them in a financially compromised position. Like, I mean, you see companies now that have espoused mission-based concepts, values, looking after people's best interests, now putting credit cards out and it was like putting old line products, high interest loans, things like that, and I think the valuation, the inflated valuations and the quickly rising valuations are going to force people in this category into making tough decisions that are problematic. So that's my view on that.
Well, let me push you on that. It's not as though Acorns has been, valued at 1x book either. It's a company that's been a high flyer. So how do you do that? How do you balance, if that's the right term, the mission orientation that you espouse on one hand with the necessity of creating shareholder value on the other?
Yeah, I mean, look, like we had a rough 2019, as you know, and the thing we didn't do was change our mission and values and principles to catch up to our valuation. Like we rode out a tough year and stayed true to what we believe and what we are. And then in 2020, we've had a really good year. And I think so I think, to have some mettle and courage as a person, if you really are about helping people, be about helping people. So I think at the end of the day, doing this and doing it right comes back to having courage as a human being.
Well, we have about a minute left. So last question. I'm not sure if this is something Noah likes to disclose, but we have mutual friends who went to college with Noah, and his real reputation is actually as somewhat of a famous DJ from earlier in his life. I assume earlier in his life. It may continue to this day. But whether it does or it doesn't, there's no doubt that you ask anyone who knows Noah, and they'll acknowledge that he's cool. And to me, as a lifetime fintech investor, I find that very odd, because cool and fintech have not historically been words associated with each other, as evidenced by the old gray-haired guy interviewing you. But can you stay cool and be a fintech entrepreneur is my final question.
Yeah. That's a good question. Thanks, Matt. By the way, I actually wrote a book called Chasing Cool when I was 27, which was about companies and people chasing after someone's sort of newfangled idea of what cool means. I think cool is being true to yourself. So, that's my view. As far as cool, as far as I think the way society views cool, I think it's probably tough to be a fintech CEO and be cool.
Although your t-shirt and blazer look,
I gotta keep it real.
That's fantastic. Noah, thank you for being here, and to the conference organizers and everyone who took 25 minutes out of their day to spend with us. We really appreciate your time.